Rameesh Kailasam. I'm the CEO of indiatech.org. Indiatech.org is an industry body which has been set up by the founders and investors focused on the Indian startup ecosystem. We work closely with industry and governments towards creating a conducive policy and an enabling regulatory environment for the Indian startup ecosystems. That includes the early stage startups to even unicorns across a range of issues. Broadly, we work on issues that enable wealth creation within India. And we are currently working on a range of issues, right from enabling IPOs in India to listing, ease of doing business across different sectors, and of course, market enablement. I have the pleasure of moderating the session today, wherein I have with me Ananth Narayanan. Ananth needs no introduction. Ananth, as you all know, is an active investor and an entrepreneur in the consumer internet space in India. He's the founder of Mensa Brands. Mensa Brands, as you all know, looks to invest into and work with founders of digital-first brands and scale them globally. Most recently, he was co-founder and chief executive officer of MedLife. After scaling the business, he successfully merged it with PharmEasy, creating a $1 billion plus business, which is clearly the market leader in the healthcare technology space. Prior to this, he served as CEO of Myntra, the country's largest platform for fashion and lifestyle products, and part of Flipkart and Walmart. Under his leadership, the company witnessed 6x growth in a span of 3.5 years, which improved profitability along with the right foundation for the long-term success of the company. He was also instrumental in buying Jabong and consolidating Myntra's market leadership. Featured as one of India's hottest 40 under 40 business leaders in 2014, Ananth has deep expertise in driving performance improvement and digital transformation. Prior to Myntra, Ananth was at McKinsey & Company for 15 years, working across 4 offices in Chicago, Shanghai, Taipei, and Chennai. He serves as the independent director in the board of Marico. Apart from that, he is also associated with a lot of not-for-profits, where he's working on a range of issues that impact socially. He's also part of the transformation and conclave set up by Niti Aayog under the aegis of the Prime Minister of India. He's also an active member of Aspen Global Leadership Network and is also in the industry advisory board of the University of Michigan. That's a huge and great body of work that he carries with himself. Welcome, Ananth, today.
Thank you. Thanks so much, Ramesh. Appreciate it.
Before we dive into the set of discussions and the exciting time ahead that we are going to have now over the next 1 hour, I would like to set some context to this conversation on e-commerce. E-commerce, as you all know, has transformed the way we do business in India. The Indian e-commerce market is expected to grow to US $200 billion by 2026 from the 38.5 billion that we had in 2017. Much of the growth has been triggered by the penetration of internet and, of course, smartphones, which are all pervasive now. Over the years, the number of internet programs have phenomenally increased, and India is now becoming a hub for startups and unicorns. We have been tracking the investment space, and over the last 3 to 4 years, we have been clocking something like $10 to $11 billion of investments coming in the startup ecosystem. But 2021 phenomenally has already seen $14 billion investment as of last month. And the deals are going pretty fast. We are also seeing exciting times with listing of Indian startups. You must have seen the Zomato listing that happened recently. So great times ahead for the Indian e-commerce space, and I will not hold much. I would request the audience also to parallelly send your questions while we are discussing with Ananth, and Ananth puts his points of view across. Ananth, over to you. I just wanted to start off on the e-commerce bit. What gets you excited on building global B2C brands in the next 5 to 10 years? What do you see that happening? I mean, do you see a great time ahead, and what gets you excited on this whole context?
Thanks, Ramesh. So firstly, guys, very excited to do this. I see almost 55 folks on, so very excited to have a meaningful dialogue. And I think, it's a Saturday morning, so really appreciate everybody taking the time to actually come and do this. I wanted to start a little bit. So it's been about 7 years for me seeing e-commerce sort of evolve and change. And the pace at which it's evolved and changed has been pretty dramatic. Just to give you a perspective, right? In 2019, e-commerce did about $34–35 billion in overall GMV, which is the amount of goods that customers actually purchased. That number this year in 2022, if the festive season goes well, will be almost 85 billion, right? And this number keeps going up. The other interesting thing is, last year, about 180 odd million people shopped online. And if you think about the growth rate of that, that's growing at about 50% year on year. So these are very, very large numbers, right? As you think about it. So if I think about the next 10 years, I think these are the golden 10 years in my mind for India. And I'll tell you why I feel that way. First, if you think about brand building, usually brand building, if you take the last 10-year perspective, has been very expensive to do. The reason it's very expensive to do is high. If you're a Unilever, if you're a P&G, you need a multi-tiered distribution network to reach 1,000 pin codes in India. With Amazon, with Flipkart, with Myntra, with Nykaa, with AJIO, that infrastructure has been built, right? And now we are able to get single SKUs to 26,000 pin codes in India within 3 days in most cases. So cost of distribution has gone down dramatically in India because of the investments that all of the e-commerce players have collectively put in, not just the e-commerce players, the logistics players, the supply chain players, all of that. The second is branding and brand building used to be extraordinarily expensive in India. I still remember when we first started the first campaign in Myntra, a bare minimum cost of a campaign used to be 20 crores, right? Because you had 1 to 2 crores of production cost, and then you needed 18 crores of media spend in order for a 6-week enough frequency for it to work. That has changed completely with short form video and with content and YouTube. The ability for brands without a lot of cost to get their brand message across has become much, much simpler. So distribution costs have come down and the way to market and brand has become very different. My belief is in the next 10 years, right, India is going to see the best growth of D2C brands that we have ever seen. And I'm going to call them digital first brands and not D2C brands, because I think they will sell through marketplaces. They will sell through D2C websites. They will sell also maybe part of it offline, but it'll be digital first in the way they think about it. My belief is at least, and this may be an interesting prediction to talk about in a few years from now, but I expect between 10 and 20 brands to be north of $150 to $200 million in the next 5 years, right? Now, if you think about that, right, there are massive brands, $200 million brands to be built. $200 million is 1,500 crore brands, right? That's just not happened in India. Also referred to global. Global e-commerce last year, Amazon.com alone did about $1.5 billion worth from India to the US, right? That number is growing 100% year on year. If you look at the global landscape, the Chinese sellers have sort of been the ones that have dominated the China-US trade. I think we have a real chance from India across personal care, across textiles, across home furnishings, across a whole range of categories to actually build global brands out of India. So one, I think we will see brands at scale emerge because distribution and marketing and branding costs have come down. And second, over the next 10 years, I believe multiple global brands will be created from India that can be really built as brands, right? Whether, there is no IKEA from India, right? Why can't we create a home furnishing brand from India that will actually create that, right? There is no Zara from India. Why can't we create that? We keep talking about Shein. Why can't we create a Shein from India? So, I mean, in every category, I think there's an opportunity for global brands to be created from India. So I'm very excited about the next 10 years and the possibilities that we have.
Thanks, Ananth. I think pretty true pointers that why can't we create those big brands coming out of India? And great to hear that if we get it all right, the next 10 years can be the golden years for this space in India. So we have been receiving a lot of questions from the audience, and some of them I had drafted as well for me to ask, and some of them look similar. So this question might require a longish response because a lot of people have asked similar kind of questions as well. Could you help us deep dive into 3 stages that a startup undergoes, which is early stage, growth stage, and the scaling stage as such? And What, in your view, does it require to make it in each of these stages from various aspects, such as right from product development, marketing, growth hacking, capital, technology, and teams? I mean, that's an elaborate deck of questions, but I think something that will lay the ground for people to understand from your rich experience.
No, thank you. I think that's a great question. The perspectives that I have are coming from two sources. The first is I've seen Myntra's private brand scale. So one of our brands, which is called Roadster, which I'm incredibly proud about, and the team that's actually built it has done a wonderful job, went from 20 odd crores. I remember when I initially looked at it, to about 1400 crores, right? And it was profitable. So it wasn't just burning money to grow. It was at a 17% EBITDA. I've also seen wonderful Myntra brand accelerator brands and several of our partner brands in Myntra and in MedLife, in, for example, nutraceuticals, scale and grow, right? So let me first define the three stages, and then we'll talk about each of the stages. The first is what I would call a product market fit stage in a brand. So for a brand to go from zero to, I would say, about 10 crores of sales in a year is one stage of a brand, right? And there it is a lot about product market fit, and I'll talk a little bit more about what that means. And you mentioned multiple dimensions, so we'll talk about that. The second you call growth stage for me is between 10 and 50 to 60 crores, right? Where you are basically starting to grow the brand and it's starting to become more and more of a brand in this pool, right? And I would say, by the way, there is 70, 60, 70, 80 crores and beyond, all the way to 500 crores, right? In terms of scale. And then it keeps going beyond that. Then there's a lot of existing momentum that kicks in. So just to dimensionalize this, for me, early stage is 0 to 10 crores. Growth stage is sort of 10 to 70, right? And then 70 to 500 is the next stage. And I think the skills, the capabilities, and what is required to succeed is very, very different. I think today in India, if you look at it, a lot of brands actually do the 0 to 10. About 20, 30% of them do the 10 to 70, and almost very few do 70 and beyond, right? Now, some part of that is, of course, timing, but a lot of it is to do with skills. So let me just cover each of them. In an early stage, the real thing to do is you have to make sure that you have a product market fit. And what does that mean? That means, by the way, you're solving a consumer problem that may be identified as a consumer problem, or there's a need, problem or need. Either way, you need to be able to solve it. The product needs to fit that need, and you need to be able to sell those products on the basis of the product quality, on the basis of reviews and ratings, on the basis of social media engagement. There, the customer basically feels, and it's mostly word of mouth and referral, right? What's important in that stage is you get that right from a product standpoint and a consumer feedback standpoint. Very, very positive consumer feedback, right, is critical at this stage. So your reviews and ratings need to be 4.5 and above, right? Your social media engagement, which is the number of people who engage on social media versus the number of customers, needs to be 1:100. So for every customer, there need to be 100 people talking about the brand, right? Because there's referrals, because the product quality is so good, right? That's what you need in the early stage. The second thing you want to do, right, that's on the product side. As you think about growth hacking, which you mentioned, in this stage, a lot of growth hacking needs to be on its own merit, which is you're not spending a lot of money in order to grow. The product is growing itself because the product is so good, right? Because there is organic recall. You invest in SEO, you invest in content, you invest maybe in a virality program and a referral program, but you're not spending a lot of money on marketing and branding yet. The product is selling itself, right? The third thing that I'm a big believer in is what I call unit economics. Unit economics is on a per transaction basis. Every product that gets bought, do you or do you not make money on it after the cost of customer acquisition? Even at a 0 to 10 crore scale, right? By the time you get to 10 crore, you need very positive unit economics. And why that's important is the following. It is important because one has to fundamentally believe that subsidy is not the reason, discount is not the reason why the product is growing. With discount and customer acquisition costs are two sides of the same coin. That's not why it's growing because of product quality, right? So that's a bit of what you look for in early stage. There, by the way, if you think about team, really what you're looking for is passionate founders, right? There's a group of 2, 3, 4, 5 people that actually are doing this. A lot of processes it's okay to be manual. Even then, I would say, by the way, having a tech DNA helps. So thinking about productizing things, you may not build everything in-house. You may partner up with good technology firms outside, but it's important in order for us to basically be able to get a tech DNA even early on in that stage. So that's the 0 to 10 crore stage, right? The 10 to 70 crore stage requires a very different set of skills. Now, by the way, if you think about the product and product reviews, all of that continues. But now you need to start investing in what I would call digital marketing and branding, which is not just performance marketing with a good return on advertising spend. You also need to start spending, and I would say between 1 and 3% of your net revenue. You need to start spending on building a brand and creating pull, right? Now, what that means is, you may not need a face, you may not need a brand face, you may not need an influencer at this point of time, but you need to create communities. You need to have people talking about your brand. The brand needs to slowly become more sort of pull, right? So in the classic marketing parlance, if you look for top of mind or spontaneous recall, at least spontaneous recall needs to be start becoming a non-zero number, right? At this time also, you need to start putting in place, in my mind, some level of processes on the supply chain side. Because usually when you start, the supply chain is fairly disorganized. However, if you look at Amazon, you look at Flipkart, you look at Myntra, you look at Nykaa, you look at Ajio, availability, inventory availability, and stockouts are a large reason of why you go up or down organic listings, apart from your product quality. So putting in place a supply chain system that can scale, right? Which means fixing your production, fixing your contract manufacturing, fixing your job work, fixing your formulation, so that they can start to scale, right? Matters. Second, you may not do it yourself, but work with a technology firm. There are many of them out there, right? Whether it's a eCommerce, it's a Vinculum, it's an Incref. Start working with some of these firms to start putting in place supply chain systems so that across the country in India, you start to think about, is there a way to make sure inventory is replicated? So their delivery times are good, the consumer experience is good. This is also the time from a team standpoint to start investing in the organization. Can you start getting young people into the team beyond the founders and maybe the very operational people to start saying, at least I would invest in growth marketing, right? Could you get a growth hacking person in place? Could you get at least a technology person or a product person who can start to think system in place, right? Could you start to think a little bit around even on branding? Maybe you don't do it yourself, but are there 1 or 2 agencies that you can start? Are there some influencer communities that you can start working with, right? That's going to be very, very important, right? In the 10 to 70 crore. The other thing that's important is at this scale, in the first one, like I told you on the business side, unit economics are important. You need very positive unit economics. In the 10 to 70 crore stage, you actually need to make money, right? And I know in e-commerce, people don't, a lot of times, we don't think about making money as much, but as a D2C brand, as a digital first brand, if you're between 10 and 70 crores, you should be making money. When I say making money, really actually at a profitability level and a free cash flow level, which is apart from the money I invest back in working capital into the company, I have free cash flow every month. The reason that's important is as you scale, capital will become a real constraint. And if you are able to think about a business that's self-sustaining, then you can take capital on your own terms and you can get the right set of people in. We'll talk about that separately. But it's important for the business between 10 and 70 crores to be self-sustained. Really important. But the skills required and a partnership that's required is really around people who know product, people who know technology, people who know digital marketing and branding, and people who can work with the founder and the teams to see how do you grow and scale the brand, right? So that's the 10 to 70 crore journey. The 70 and above journey is very different in my view, right? Because now you have reasonable scale and you need to start investing, in my view, in terms of how do you actually go from the 70 to the 500, which means, by the way, at this point, you need to start thinking about branding. What does the brand really stand for? How much money do you want to spend on branding and not growth and performance marketing? It becomes very important. Second, depending on the category that you're in, you can start thinking about global aspirations. Do you want to go to multiple countries? Do you want to be in the same country, right? Also, usually what happens with most brands is because of management constraint and founder capacity, for lack of a better word, you usually are only in one channel, maybe 2 channels. You need to start becoming multi-channel. You need to start thinking about offline, right? Because offline also makes the brand more real. in some ways. So you need to start thinking about a whole range of things around branding, around multi-channel expansion, around geographic expansion, in terms of how you actually think between 70 and 500 crores, right? And that's a very, very different game. Now, by the way, this is where a lot of brands struggle. In my mind, the reason they struggle is the organization that is required is also perhaps very, very different from what you've actually done for 0 to 10 and 10 to 70, right? And the organization now is you need people who have seen scale, because otherwise you'll make the same mistakes that people have made. Second, you need to be able to invest ahead of time, ahead of schedule in terms of the growth, right? So you need to be able to invest in a marketing campaign before the growth happens. You need to be able to invest in a technology system before you get the full benefits of the technology system. Therefore, by the way, capital and the right kind of capital for growth also becomes very important at this stage, right? So organization and team and getting the right set of people around product, technology, marketing, branding become very important. In the first stage, it was mostly around product and sourcing. In the second stage, it's a bit more around growth hacking. In the third stage, marketing, branding, supply chain at scale, global, all start to become much more important, right? And therefore, how you build that becomes very, very different. And my sense is, by the way, also founders need to evolve. They need to think about partnerships that help them evolve, right? Because a 0 to 10 is very different from a 10 to 70, which is very different from a 70 to 500. And it's a lonely journey, right? So you also need to look for right partners. And I've sort of done this 2-3 times before, and it is very lonely to be an entrepreneur and a founder, right? All the problems come to you. So how do you find the right help across these stages that will help you grow and scale the brand so that your overall objectives around building this into a household name perhaps become something that becomes more real, right? And I would say I've now maybe spoken to 400 plus brands, both in Mensa and in MedLife and in Myntra. I would say people are very, very comfortable with the 0 to 10, right? 10 to 70 starts to become a little bit more of a struggle. And the 70 plus people really struggle, because what happens is the skills, what got you here doesn't get you to the next place, right? And it's very hard, right? Because, you've sort of built a fabulous business from nothing, right? And so you feel really good. But the problems that you see are now very different and problems that you have not encountered as you think about what needs to be done going forward, right? So I would say the team needs to be very, very different, needs to be very thoughtfully done. And the skills and capabilities need to be thoughtfully done across all of these. Sorry, I know it was a long-winded answer, but I hope that helped. But the summary of it for me is 0 to 10 is about product market fit, very passionate founders, sourcing and design. 10 to 70 is about understanding product technology, your customers, putting in place some process and growth hacking. 70 and above is about global growth, multi-channel expansion, omni and growth.
Thanks, Ananth. I think that's a fabulous insight. In fact, at India Tech, when we keep encountering many of the early stage startups, we tend to hear the same kind of story where 0 to 10 seems to be, if you've got the passion right and your ideas in place, 0 to 10 seems to be the greatest time they seem to have, right? Including the early stage employees who are part of it.
Correct.
But when the 10 to 70 stage comes in, I also see a bit of insecurity creeping in amongst a lot of employees to say, oh, are we being tested? Am I skilled enough to scale up? And even the founders, as you rightly pointed out, need to evolve. Because more often, I mean, when they get it into the next stage, which is the growth stage and the 10 to 70 stage, many of them are still averse to partnering. And as you said, you learned it your way, your hard way or whatever. But most of them are actually averse to partnering because sometimes they get this insecurity that, okay, maybe my idea will get copied. Maybe somebody else may hijack the whole agenda away. I mean, you have all those insecurities creeping in. Plus, correct. Of course, being large-hearted to partner is also something they need to evolve, which is something I see missing. They need to probably hear people like you out more. This conversation is an eye-opener for most of them. And of course, there's one more thing I wanted to add from what I heard from you, because it's a pretty exciting segment, is that I could compare some of them with running with the same single engine, but adding more wagons to the goods train. And then suddenly they realize that they are not able to drag or pull, but they're refusing to acknowledge that I need more engines to be added. Could be co-founders, could be kind of senior level staff.
Right.
What do you think? Is that an apt comparison?
I think it is. I think it is. And it's hard to sort of add multiple engines because you don't know then the value of your own engine, right? So I think it's important. And I think, but look, my belief in this is if you want to build a brand that's a household name, you have to look beyond yourself. You have to look beyond being just the founder. You have to sort of say, look, I'm building a legacy. I'm building something that will live far on beyond me. This brand will live on forever. That's how the global brands have been created, right? When you think about any of the brands that are household names, right? They've been built because people thought beyond the founder, right? And I think it's important. And I think there is no doubt at all in my mind that different stages of growth need different kinds of partnerships. And being open to that is what will determine whether you go from 0 to 10 and stay at 10, or whether you go from 10 to 70, or whether you build a 500 crore brand, right? By the way, nothing wrong in being a 10 crore brand either. I think it's a very good thing. I think 10 crores is it's a wonderful effort and people have been built. But if you like the fact that you want your brand to be a household name, then you have to sort of think about the right people to help you and the right partnerships to help you, because that's how you'll scale.
Well, that moves us on to the next question, which is again a combination of questions that has come in, but I think leading on to what you said, what are your views on how do you build the right teams at each of these stages, the 0 to 10, 10 to 70 and 70 to 100 stage,
right?
And what do you look out for? That's part one of the question, and part two of the question is, and this is a basic one in a sense that people do play an important role in each of these making of the brand, breaking the brand, growing the brand, all of it. I mean, I've heard of cases where people built it fabulously in 0 to 10, 10 to 70, they were going great guns till probably the 40, 50 numbers, and then suddenly things started falling apart.
Yeah.
How do you make sure you identify the right people and the teams, and how do you resource it in the journey?
Yeah, no, again, great question. I'll try and answer this in a couple of different ways. The common theme in my mind across all three stages is you need to find people who are great culture fits and who are passionate about the brand and the product, because that's the core value in my mind, right? Because, there's no point being very efficient, very good, but not having a passion for the product, right? So having a passion for your product is very important, and that needs to come through all across in all three stages, right? Now, in the first stage, 0 to 10, you need people who can hustle. You don't need people who have a lot of system and process thinking. In fact, that may get in the way. If you get a 20-year Unilever guy, and I don't mean Unilever, it can be a company X, company Y, right? What happens is they are used to having a set of systems and processes. Product development is a process, right? Marketing branding is a process. You're used to Nielsen reports. You struggle, right, in the 0 to 10, right? Because ideally what you want is you want basically people who can, without systems and processes, be truly entrepreneurial. So that what you're looking for is, apart from passion, just hustle and energy and the ability to sort of do jugaad and get done, right? You have to get stuff done. That's the characteristic you're looking for in the 0 to 10. 10 to 70 is interesting because you need to start shifting that mix. You need to go from 80% hustle to 60% hustle and 40% system, right? And that's a difficult balance to get. The reason I say that is what happens is, I've seen this again, right, in multiple startups where, the brand is now 30 crores, growing at 100% year on year. There's a venture capital investor who's come in. They say, okay, you need to get a senior guy, right? Because that's what's going to help the founder. Now, the problem is a senior guy doesn't exactly know how the founder works and the hustle works, right? So if you get a senior guy in, just put him in. There are two things that can happen. One is, by the way, the person can adapt to the style. The second is they really struggle, right? Because you're not able to have the systems, processes, and support, right? And you have to get the balancing act right between the two. So in this, what I look for is actually get younger people who have seen scale, not necessarily folks who have done this, been there, done that. So it's a very important nuanced point. You don't need to find, if you're a beauty brand, right? Don't get the most experienced L'Oreal guy on board. Actually find an e-commerce guy in a slightly different but associated category and get that person in. Because one, they've seen scale in a Flipkart, they've seen scale in a Myntra, they've seen scale in an Amazon, right? But At the same time, so they've seen scale, but they also understand hustle and they're young and they want to learn, right? So find people with scale experience, but not necessarily in the same area, right? So that you don't come with preconceived notions about how a brand can be built. That's the kind of people you want in the 10 to 70 range, right? In the 70 and above, you then shift again. Because now I think it becomes 40% hustle and energy, but 60% you need systems and processes, because you can't do 200,000 deliveries a day on only hustle, right? You can do 2,000 deliveries a day, right? 200,000 starts to be need systems and process. There, I think having expertise matters, right? Which is, you've been there, done that. If you're a supply chain person and you haven't seen 200,000 and you haven't seen 150 distribution centers, very hard to imagine how you'll do 200,000 deliveries, right? Because you'll start to reinvent the wheel. So they're thinking about competence and expertise in domain becomes important. The thing that I would say even there is think about culture fit, because now you need an orchestra, right? The orchestra has to work together. So finding the right fit for the founder and the culture for the founder, along with some senior execs, is important. And that's a different kind of balance. So just to summarize again, right? You're looking for 90% hustle and 10% systems thinking in stage one. That number becomes 60-40 in stage two and 40-60 in stage three, right? And in stage two is the hardest one to hire for. And stage three is a little easier because at least you have sort of have proven models, right? So stage two is the critical one to get right. And there you need to get the right level of energy, hustle, and not necessarily domain expertise. I hope that helps.
Yeah, absolutely. I think great terms. I'll start using them, hustle and of course experience. But leading on to this, I mean, again, as a follow-up question to the same question, most of them, I mean, from whatever I've also seen on the field, this question often comes across. Right. That in the beginning 0 to 1 stage, it is like a, as you said, it's a business running on Jugaad. It's like a mela, you know, what is called a fair, right, where everybody is walking around everywhere and trampling all over, but doing stuff, because that's the passionate stage of building the product and building the idea. You don't have any systems and processes in place, hopefully on 0 to 10 stage. I mean, that's a given. Right. When it goes from 10 to 70 and you see this transition happening, more often the question comes in saying, when should that founder put a system and process in place? And the reason why this is important, because you did mention that a couple of times, the dilemma that most of them face is that, should I put it now or should I put it later? And sometimes the later becomes too late because you've grown into a huge animal and it's difficult for you to now even control it. And systems and processes look like as if like on a raw big organization, you're setting up a system and process, or you set it up so early that people tend to get afraid and run away. Right. So I guess the answer is it depends on the function. So for example, I would say in the 10 to 70 stage, put in place real systems for supply chain, right? Don't worry so much about growth hacking. Just to make it practical, right? Because you need not a system, you will try 50 experiments and it may work, may not work, right? Don't put too much of a system in place for product launches because you want to hustle, you want to be able to get low MOQ, you want to be able to try products. But delivery and consumer experience, start to put real systems in place. Finance and accounting, start to put real systems in place because at some level, you need to be able to manage cash flows and finances. So I think being thoughtful about where you put systems is important. In my mind, in the 10 to 70 in supply chain and in business finance are the two areas that I think you need to actually put real systems and processes in place. And I don't think you should put places in product launches as well as in some of the other areas, right? Like I mentioned. So I think being thoughtful about those two is important because you need to know what is the engine that drives growth and what is the engine that actually breaks because consumer experience is broken, right? So you want to try and balance both those out. Absolutely, and couldn't agree more as far as the accountant is concerned. I'm an accountant myself. I often find that you don't want the taxman knocking at your door either in 0 to 10 or 10 to 70 stage. So keep that part clean. Compliance is a must. Correct. That moves us on to the next question, Ananth. I think great insights so far, and this next question is largely around investors. Yeah, and I mean the question is. What do you feel? When do you actually think that a startup really needs an investor? Because you have typically 2-3 kinds of startups, right? One which starts actually generating money, one
Yep.
which is just acquiring customers and generating zero money, and
Right.
one which is a mix of both, where it is burning money and acquiring customers, but not really generating any tangible revenue, but there is
Right.
still some revenue coming in. So the dilemma of the startup founder is, should I look for an investor now? Should I not? Should I survive on revenue? Should I burn my own
Sure.
money? So when is that stage coming in?
Yeah, yeah. No, I think it's a very nuanced question. So let me try and answer it. I actually don't know. I haven't seen the list of participants. I don't know there are any investors on the call, but let me answer it anyway, right? I think firstly, by the way, you don't bring an investor only for money. I think that's the first thing to just sort of, that's my first rule. I think investors have to bring in more than money. I think there's a lot of capital in the world. So you have to add something more, right? Now, I think as you think about it, why do you need capital, right? So the first is, to get started, you need capital. So in the 0 to 10 stage, depending on who you are, how much savings you have, how much money can you invest yourself, actually having some level of seed money to get you there from 0 to 10 is helpful, because you have to invest, you have to hire some people. Not everybody can go without a salary. All of that is important, right? Ideally, in my view, in the 10 to 70 stage, you should be generating enough money. There should be free cash flow. You may not be able to take home a lot of money, but the money is enough for you to invest back in working capital and invest back in marketing so that the growth engine keeps continuing, right? So you don't take the money because you need capital. You take the money because they will add more than just capital, right? I would say that's the second framing. Since we're talking about digital first brands in this session, right? Not talking about all startups. I think all startups is a very complicated question. For digital first startups, right? Brands in particular, because you should be able to make money. And the reason to take, therefore, capital is for growth investment, for network, for basically allowing them to connect into various things, etc. Now, if you think about investors, I would say there are many different kinds of investors, right? There are venture capital investors who have a certain time horizon and a certain return on invested capital requirement. Usually it's a 7-year return and you want 100x, right? Because you're investing relatively early. There are private equity investors who do a little bit more growth stage, but expect more muted growth with less risk, right? There are strategic investors, right? Who could be large companies who come and put in money because your product becomes a better part of their portfolio. And now I would say there are investors such as us who are operator investors like Mensa, who basically think about it as a combination of both investing and operating, right? So you sort of think of it as adding another co-founder to your team and sort of bringing both capital and expertise in. So these are 4 very different types of investors, right? And I think the answer for what you want depends on who you are and what your aspirations are. So I don't think there's one right answer for everybody. So I'm not going to tell you that Mensa is the right answer for everybody or VC is the right answer for everybody, right? So the first thing is, if you can self-fund, right? There's nothing wrong with it. I think it will limit to some extent the extent of your growth, but you can build a long-term sustainable business, right? Second, if you believe that you're going to take venture capital money, remember that the money is coming in as primary into your company, right? Which means the money comes into your company and that comes with a set of expectations, naturally so, from the investors, right? So therefore your growth rates, how you work with people, all of that will change, right? Strategics and investors like Mensa actually usually have a longer term time horizon. The reason is we are very patient capital. We don't have to return the money to anybody, right? It's unlimited capital forever, right? So for us, I think the goal is you need patient capital as far as brands are concerned. Brands, by the way, need a 10-year cycle. They don't need a 5 or a 7-year cycle. The reason I say this is, look, I mean, 3 years ago, right? Apparel brands were going through the roof. Currently, beauty and personal care brands are going up, right? Maybe nutraceutical brands will go up next. Maybe decor, home furnishing will go up after that. But it's a cycle. It keeps going up and down because of demand, because of economics, all of that, right? The investor that you want or the partner that you want, I would use the word partner more than investor, right? So there are 2 choices, whether you want an investor or a partner, and they're 2 distinct choices, right? If you want an investor, do some real diligence on the investor and how helpful they will be to you. If you want a partner, understand what skills they bring beyond capital and how will it be working together. My short answer is life is short. If you're a young founder, anybody giving you money feels very big, right? I mean, I've been through this, right? I think raising 50 million, 100 million, 20 million, in Flipkart days, billions, all feels very good. It's a good sort of ego thing and so on, right? But remember that day-to-day matters more than your valuation. Valuation is a notional number, right? At some level, you have to run the business. You have to keep running the business. So the question I would ask if I was a founder is, what is the thing that gives me joy day to day? And who are the set of people that can really help me as I scale the brand? Start with that question and then go to the investor and partner answer. Sorry, I know it's a little bit of an unstructured answer, but hopefully that helps.
Yeah, absolutely. I think this is the part which is unstructured in people's minds as well. On how do I go about, and sometimes people come back and say, I didn't like the face of the investor. I didn't like the attitude of the investor. I didn't like, or on vice versa, they would say, this guy actually got my brand. He got my idea. I'm very thrilled. I want this guy to be my investor.
Right.
I mean, that's the kind of responses that often keep coming. And I think that's also a journey each of them have to go through, apart from, of course, running the businesses. We have, great insights so far, Ananth, and we do have a lot of questions coming up from the audience as well. We'll start.
We can jump to the questions. Absolutely.
Yeah. So one of the questions that has come in is, and I'll come to just to break the monotony, I'll ask a very odd question that has come in.
Yep.
How do we tackle copycat brands and products? I mean, this is a question that has come in.
Yeah. So I think the first is, by the way, if you're building a good brand, expect copycats. Right? I mean, if not, I mean, it's a bit of a problem if nobody's copying your brand. So people will copy your brand, right? The only way in which you can manage this is being ahead of the curve. Only way, which is continue to be better at product development, continue to be better at branding. Obviously, things like trademark registrations, all of that you should do well. So people shouldn't be able to copy your brand, right? That I think is a problem. But if you think about products that are very similar to yours, that will happen, right? There's a certain ingredient that's a flavor of the month. Somebody else will copy the same ingredient 1 month later. So that'll happen. The only way, in my mind, to manage this is actually to have a product development engine that keeps firing, right? And you keep going and you're just better at execution. Unfortunately, there is no rocket science answer. This is not an IP innovation. I have a walled garden, right? You have to keep better. You have to be better at executing day to day on product development, on branding and growth. Only then can you stay ahead. Otherwise, by the way, there will always be similar products that come out over time.
Yeah, and as you rightly pointed out, I think that is true for most of the products where constant innovation is what keeps you ahead of the curve.
Right.
I mean, you might come with a bright idea, but if you don't plan it out and scale up and continue to add ingredients, somebody is going to copy that, because nobody's inventing rocket science, but you're inventing a smart way of doing business. So that's the trend. There's one more question which has come in, which is on how do you make a brand website versus a marketplace decision? What mix one should aim at?
No, again, a terrific question. In my mind, by the way, again, it goes back to the stages, right? I think, so firstly, marketplace is always the easier way to scale. Right? It's just the nature of it, because somebody else has brought the traffic to the website. You're only playing for visibility and conversion, right? Amazon has brought traffic, Flipkart's brought traffic, Myntra's brought traffic. You're not bringing traffic, right? So there's no brand pull. You're only trying to figure out the Amazon ads or the Flipkart PLA or whatever else, right? So it's an easier way to scale. However, as you scale a brand, you get less and less and less data about who your customers are and how do they behave if you only work through marketplaces. And the reason is, by the way, the marketplaces by definition don't share their customer data because they're their customers, right? However, to go from 10 to 70 and 70 to 500, you need to know who your customers are. You need to have a feel for the customers. So I would say 0 to 10, 10% of your business coming from D2C, 90% from marketplace is okay, right? From 10 to 70, I would say you need 20% of your business coming through that, right? And beyond 70, right? Maybe 30, 35% of your business coming through D2C. And the reason that's important is you then get a real feel and flavor for your customers. You know what your repeat rates are. You know what your cohorts are, right? And that becomes really, really important for you to build a real brand, because that's what allows you to stay in touch with the customer, which you don't actually get otherwise.
Yeah, and there's one more question which has come in, which is, how do you balance the decision-making process of growth versus profitability in an early stage?
Yeah, another favorite question of mine. The short answer is, after my multiple experiences, guys, don't burn money. I think if you're at the mercy of the capital markets, it's always a bad thing. So I would say always be unit economics positive at the CM2 level. And CM2 is for me after the cost of customer acquisition, right? So that should be one cardinal rule that as a digital first brand, you don't break, right? Unit economics need to be positive, in which case scale is your friend, right? As you grow, you can cover more fixed costs, right? So that's rule number one. Rule number, and don't break that at any stage of the journey, 0 to 10, 10 to 70, 70 to 500. Don't break that, right? Now, I think it is perfectly okay, depending on the amount of money that you have in the balance sheet and the capital that you're able to raise, to invest ahead on team, on technology, on branding, right? So in the 10 to 70, in fact, I would say investing 1 year ahead, right? And not making any EBITDA, but actually investing all of the EBITDA back into growth is not a bad thing, right? And then as you think about the 70 to 500, there's an opportunity to invest more, right? You might decide that, omni-channel and offline is something that you want to do. And therefore that requires investment. So I would say keep unit economics as the golden rule for always being positive at all stages of the game. And second, if you think about investments, be very thoughtful and say these are investments and measure the return on investment. I would say branding, technology, and team are 3 areas where I think it is okay to forward invest between 6 months and 2 years, right? Depending on where you are.
Great. And since you mentioned 70 to 500 often, there are 2-3 questions which have come on the 70 to 500, and I'll read both of them.
Sure.
I think you can answer them in parts. The first one is, how do you reduce dependency on e-com platforms when you are on the 70 to 500 stage? I mean, you can take that question now, and then we can get to the next one.
Yeah, no, I would say, by the way, India that way is actually quite unique, right? If you were in the US, I think your dependence on Amazon would be very high because that is the e-commerce platform. So firstly, I would say, even in the e-commerce platforms, keep a balance across all the platforms, because there are at least 3 large groups, right? There is going to be Flipkart as a group with Flipkart Myntra. There is going to be Amazon, and there is going to be AJIO, right? At the very least. And then there are vertical players, right? Whether it's Nykaa or others, right? So it's important to sort of keep a balance, in my view, across the e-commerce marketplaces, so you're not completely dependent on one marketplace, right? In a marketplace also, the way to reduce risk and dependence is through consumer love. If your reviews and ratings are good and you're on a marketplace model with them, then it's a less risky proposition than if you're an outright with one particular platform, right? So that's one way to answer the question. The second is, I think, what we spoke about in the earlier question around D2C. I think thinking about D2C as a brand, as a channel, right? And I think it's important to sort of build that over time, because it gives you the customer connect and it gives you an independent source of revenue, right? Third thing I would say is, depending on your category, it may not apply to all categories, right? If you're right, I mean, but let's assume it applies. Think about global as well as a way to de-risk it. And the last thing I will tell you is, remember, the platforms also look for good brands. Eventually, what customers want are products and great service, right? So yes, there is dependence on the platform, but the platforms also need great brands, right? Because without great brands, you don't get customers. So continue to focus on building what you think is a great brand, and everything else will follow, right? But from a risk mitigation, I would say manage across platforms, manage across business models inside the platforms, and also think a little bit around your D2C and global as other ways to reduce risk.
Yeah, and there's one more question on the 70 to 500 category.
Right.
There's a question which says, what are the hardest roadblocks that you encounter in this 70 to 500 segment?
The first is the team. The team that got you here won't get you there. I think it's very hard to do, because you've sort of gone through the thick and thin of toil of, you've gone through all the difficult times, you've packed boxes together, right? But yet you figure out that the 4 people who joined along with you, along with the founder, are not the right people to do 500 and above. And making that decision, I found, is the hardest. By the way, that's not just true in D2C brands and digital first brands. It's true in large platforms. It's true in Myntra. It's true in MedLife, right? It's very hard to do, because you have to make tough people decisions, and you have to get a set of people, and you have to manage the current set of people who may or may not scale. And being thoughtful and careful about doing that, I think, is important. So I think that's probably the hardest problem in my mind. The second big problem, I think, is investing in technology and product, because it's hard as a digital first brand to get the right kind of talent, right? In terms of building the product and tech for a single platform, right? Even at 70 crores, because, tech talent is just hard to come by, building the tech team. Therefore, one of the reasons not that this is a plug for Mensa, but one of the reasons we think about Mensa as a value-added player is you're able to invest in technology across a portfolio of brands, which becomes a lot easier to do than for a single brand.
Yeah, absolutely. And adding on to that, there's another question which now switches back to the earlier bracket, which is the 10 to 50 crore stage.
Right.
There's a question around that, and this is a question I think you would be able to answer it more aptly, because it says, what are your thoughts on building a digital-first luxury fashion brand at, say, 10 to 50 crore stage? I have tried to search for brands, have spoken to agencies, but there doesn't seem to be a single successful example, if at all, purely basis discounts. I mean, that's the verbatim question that has been put for.
So I think luxury, so the average ASP for fashion is 1,400, 1,500, 1,600 rupees, right? And that's on the higher side. Luxury fashion in online just hasn't taken off, quite honestly. And the reason is it's quite interesting, because if you think about luxury, it's a very small segment of the market. And that small segment has access to global luxury because they travel, they have exposure in airports, they go to the same customer who wants to buy Louis Vuitton buys it in Paris, right? So it's a tough category to crack, is the short answer in my view. I think if you take a 10, 15-year lens as opposed to a 5-year lens, I think luxury will become big in India. Luxury has become very large in China. As GDP per capita goes up, luxury will start to become big, but you need very long periods of time and patience. You can't sort of think about this as a 3-year game and a 5-year game. You have to think about it as a 15, 20-year game. And a lot of people don't have that kind of patient capital, which is why I think it's very hard. It has been very hard. And that's why there are so few success stories of luxury brands in India.
And there's a question specific on Mensa. How do you value D2C brands generally and in Mensa specifically?
Yeah, no. So I think a terrific question. So the way I would answer that is, firstly, how do you value a D2C brand? Over time, you value a D2C brand based on both growth and free cash flows, which is a determinant based on profitability, right? Even a venture capital firm eventually does that calculation. Their time periods may be different, but that's what they try and do, right? In terms of what we look for in a brand, I would say, by the way, that we look for 3 things. The first is consumer love, right? Which I think is the most important for me, more than financials, more than anything else. Reviews, ratings, social media engagement, all of that is important. The second thing as Mensa that we look for is, frankly, founder quality and passion. Because in Mensa, we're partnering, right? We're not trying to sort of just take over a brand. We want to work with the founder for between 2 and 5 years and work together and figure out a way to scale. So is that person the right person for us to work with? Can we work together and add 1 + 1 becomes 11 is the sort of thing, right? And the third thing I would say, which is quite important for us, is on the financial side. If you have an EBITDA number, we think about it as an EBITDA multiple, saying, can you do something that's fair? Because there is an investment upfront. The way the Mensa model works is, the initial stake that we buy, which is a majority stake, is something where we actually give it to the founder. So it's actually cash out of the company into the founder. And then we continue to invest in the brand. And the remaining portion continues to grow and become valuable for both the founder and for Mensa. So I think it's a complicated answer. I don't think there's a number to it, but I think the way I think about it is consumer love, founder quality, and then on the financials, some multiples of EBITDA that make sense for both the founder and us. And there is a way to share the upside over 5 years. That's how we think about it.
And there's one more question, I think, from your past experience, it will also help. This is around supply chain management efficiencies and cost optimization.
Right.
When do you get that in, and which stage, and when do you put processes in place for that, or do you just randomly manage? So, I mean, what would be your answer typically if you look at the 3 stages? When should this?
I would say from stage 2, you need to start looking at supply chain and cost in a very meaningful manner, right? In the 0 to 10, you're fine, right? I mean, in terms of, you may not have the most efficient supply chain. In the 0 to 10, I would say don't optimize for cost, but still optimize for consumer experience. So your delivery times don't get delayed, but you may pay more per packet, right? But from the 10 to 70, I would say start to focus really on cost per package in addition to the consumer experience, right? And I think also start to manage working capital very differently. Start to manage inventory, working capital, because those become systems that are important for you to scale. Otherwise, you will find that you have lots of working capital locked away and you're not able to make growth happen. Or you have a lot of dead stock at the end of 6 months that you need to liquidate. So those start to become bigger and bigger problems as people scale.
So I think we have answered most of the audience questions. I think usually it doesn't happen. The audience gets its chance to get all their questions answered. And I think, Ananth, you've been great answering all of those questions so candidly from your rich experience. One question that probably if you were to sum up, I mean, we went through this journey of discussions where I'm sure many of the people who have logged in would have loved the understanding, and it leaves a lot of them to introspect actually, because I think I certainly have a lot of things to take back. Tell folks who have been telling me these questions that, hey, probably you need to talk to Ananth to know more, or let me take off some of that gyan and show it off with the rest of the crowd that I'll encounter from today on. But if you look at the 3 stages that you demarcated, and we look at it as 3 different verticalized way of the same organization, right? I mean, it behaved 0 to 10 in one way, 10 to 17 another way, and so on. What are the tweaks? I mean, at each stage, now you did mention people as an important pillar. The question obviously comes as 0 to 10 is where you run it as it grows along. I mean, it's like inorganic, it can go all over. If a focused founder was there, he or she might put systems in place. But the people part comes very tough. I mean, people need to say, okay, maybe I can't carry this team along anymore. I need fresh hands. And how do you go about? I mean, there's a question that often comes in is, do you now be clinical and say, okay, 0 to 10 guys, travelers, get off the bus, new bus come in, new travelers come in, some of the old 1 or 2 jump along. Scalability comes in. Sorry, you guys are now old school. Get out. I mean, how do you balance that out? It's a tough thing.
So I think great question. So I mean, we have 2 minutes or 3 minutes left. So let me do the following. I'll answer this question, and then I'm going to take a couple of minutes to summarize our entire 1 hour together. Let me at least make an attempt at it, right? So I think for sure it's not clinical. Look, I mean, brands are built by people. People are incredibly passionate about brands, and so it's a virtuous cycle. So absolutely, how you do what you do matters as much as what you do. So for 1 minute, the takeaway should not be, get rid of your team at 10 crores and get a new team in, and then get a new team in at 70. However, I think you have to be thoughtful about people's skills, and you have to take emotion a little bit out of how you make decisions about how you think about scale, right? Therefore, how you do it matters, right? So it's not being brutal with people. It is basically saying, how do I coach people to grow? That's step 1. And with coaching, the people don't grow. How do you bring additional reinforcements to help the brand and the company grow? And how do you make the right decision? So that's the way I would think about it, right? So that's the answer to that question. We're at 11:28, and I know we have 2 minutes left. I just wanted to maybe take a couple of minutes. I think we have almost 80 plus people, right, who are on at various points of time. Firstly, I just wanted to say thank you, Ramesh. Thanks for moderating, and I think also thank you to everyone. It's 10:30 on a Saturday morning, so I was unclear whether we'll have 5 people or 50 people. We have exceeded, and we've got 80 people joined, so it's great. So thank you for doing this. I would say, in summary, here are the 3 things I'd love to leave you with. Number 1, the next 10 years are the best 10 years to build global brands out of India. Right? This is the best time to do it. And I think each and every one of us is incredibly lucky to be in this space. Right? Second, be self-aware of when you need help. I think the stages of growth are very different. The skills are very different between 0 to 10, 10 to 70, and 70 and above. Third, think very carefully about who are the right partners, whether it's someone like Mensa, whether it's a venture capital firm, whether it's X, a strategic, because they bring very different things to the table. Right? And at least from our standpoint, and a lot of us at Mensa, what gets us up and going and passionate about it is working with outstanding founders such as yourself, right, in the audience, to really build and scale brands, right? That's what gives a lot of us joy. And I think very, very exciting times. And I'm hoping that if this is helpful, we continue to do this at some level of frequency. And I would love some feedback from people. You can post it on the chat. You can post it on wherever else on whether this was helpful and whether more sessions like this would actually be useful for everyone. But just wanted to say a big